This is video 3 of example 8 dealing with the category financial asset at amortized cost. I'm having a look at the journal entries in the accounting records of Luan Limited, who is the investor in the debenture. So the first journal entry is day 1, initial recognition. Now a debenture is a financial asset. All financial instruments, including debentures, on day 1 have to be recognized always at fair value. This debenture was issued at 95% of the nominal value. It was issued at 950 Rand. Is that fair value? Remember, initial recognition, day 1, always fair value. Is this fair value? Well, it could be, but we didn't say that in the information. You can't assume it is fair value. So you are going to do a fair value calculation. And the way you are going to do that is to take all the future cash flows of this debenture and discount them back to the present value on day 1 using a market-related interest rate. So you are going to calculate a market-based day 1 PV representing the fair value. So to do that, we need to use our calculators. What are we going to enter into our calculators? All the future cash flows. So if you have a look in the solution, they show you all the cash flows. But the first cash flow they give you is the cash flow on day 1. It is the purchase price of 950 Rand and the transaction cost of 75. Those were the cash flows that took place on day 1. We are looking for the future cash flows. So at this point, we are not going to use this cash flow for anything. We want to know what are the future cash flows so that we can discount them back using the market-related interest rate. So what are the future cash flows? You go down the timeline. Remember this debenture. There's 2011, 2012, 2013. It matures in 2 equal annual installments starting on 31 December 2012. The next one will be 31 December 2013. So as you go down the timeline, you reach the reporting date of 2011. What cash flow happens in the first year? Future cash flows, not day 1. The first interest. What is the amount of the interest? Nominal value times nominal rate. So your first interest amount, nominal value times nominal rate, is 100 Rand. Then you continue down the timeline. You get to 31 December 2012. What were the cash flows in this year? Well, first of all, there was interest again. How much interest? Nominal value times nominal rate. That is the cash flow. Another 100 Rand. What else happens? Well, this debenture matures in 2 equal annual installments. So the first installment takes place on 31 December 2012. How do I calculate that installment amount? It is the nominal value of 1,000 Rand. It is matured in 2 equal annual installments, so divide by 2. So 500 Rand nominal value will mature now, and 500 Rand nominal value will only mature at the end of the next year. Does this debenture mature at the nominal value? No, it matures at a premium of 110%. You could also have said at a premium of 10%. How much more than the 100%? How much more than nominal? An additional 10%. So this maturity payment is 550 Rand. The next one will be 550 Rand again because they told you it matures in 2 equal annual installments. If we then have a look at the cash flow in the next reporting period, 2013, we have already looked at the maturity payment, but what about the interest? Have a look at the amount of the interest. It is no longer, it is no longer 100 Rand, it is only 50 Rand. Why? Look at the calculation, 500 Rand times 10%. Why is that different? Why is it no longer nominal value of 1,000 Rand times nominal rate of 10%? Well, it is still nominal value times nominal rate, but it's the nominal value that is still there, that has not been redeemed, that did not mature, that was not repaid. How much nominal value is still outstanding, is not paid back to the investor yet? Only 500 Rand, because half of the nominal value was already redeemed on 31 December 2012. So now that we have all our cash flows, future cash flows, remember we are going to ignore that first cash flow because that is a day one cash flow. We are looking at future cash flows. We are going to enter these cash flows in our calculator. The problem is the cash flows do not stay the same. At the end of the first year, the cash flow was 100 Rand. At the end of the second year, the cash flow was 100 Rand interest, but also 550 Rand maturity payment. At the end of the third year, the cash flow was 50 Rand interest and 550 maturity. So at the end of each year, the cash flow is different. Because of that, I cannot use my normal functions on the calculator, payment, and future value, because the payment is not the same every year. The interest was 100, then 100 again, then only 50. The future value is not only on one specific date. The repayment is done in 2 dates, 31 December 2012 and 31 December 2013. So I will need to use the cash flow function on my calculator. Now, very important, because you are looking for day one, PV, what you enter into your calculator, the first amount you enter, your calculator will see as the day one value. So to tell your calculator, that's the one I'm looking for, I'm actually looking for PV, you need to enter a naught and then press CFO naught, cash flow naught. Then you bring in the year one cash flow, 100 cash flow 1 at the end of year 1. Then you bring in the cash flow at the end of year 2. Both amounts together, they both happen on the same date at the end of year 2. That's cash flow 2, and then you bring in the cash flow at the end of year 3. Both of them together, they both happen on the same day at the end of year 3. The interest rate you use is the market-related interest rate. They gave us that market-related interest rate, and you ask for the net present value, PV, day 1, and this represents your fair value on initial recognition.